Hi, and thank you for joining us for the third quarter market review and outlook. My name is Jason Gunkel, and I lead our investment team here at Severson Strage. The third quarter was relatively flat for the stock market. The market rally continued in July, but lost some of its momentum in August and September. The U.S. stock market is still having a very good year, with the Russell 3000 index up about 16.5%. Bond prices in the U.S. and abroad fell in the third quarter as interest rates continued to climb. The Bloomberg U.S. Aggregate Bond Index was only slightly positive for the year, with up about 0.3%. We are recording this with about a week left in the third quarter as a disclaimer on these returns. The equity market is largely being driven by tech stocks, including Nvidia, Meta, Tesla, Amazon, Apple, Microsoft, and Google. These 7 companies currently make up about 30% of the S&P 500 index, and they have contributed about 70% of the S&P 500 performance year to date through August. This chart shows how well these companies have done this year, with Nvidia, Meta, and Tesla having returns over 100%. We have continued to see better than expected economic data, and most companies beat second quarter earnings expectations, according to Bloomberg. We are seeing more optimism reflected in future earnings expectations, with analyst estimates for the third and fourth quarters of this year steadily increasing. So can the stock market rally continue? Looking at how expensive stocks are based on their price to earnings ratios, there are many parts of the stock market that still appear attractive. While large growth stocks, and in particular technology companies, have price to earnings ratios that are above their 10-year averages, higher dividend paying stocks, smaller size companies, international stocks, and emerging market stocks all have current price to earnings ratios that are below their 10-year averages. This would indicate that their prices have room to move up, especially if earnings continue to climb. While overall inflation still remains high, the 12-month change in the inflation rate has come down to near 3% and is close to the Fed's target of 2%. The inflation rate for food and housing is still relatively high, but has been moderating across other categories, including core goods. It is noteworthy that the 12-month inflation rate increased in August, which was the first monthly increase since inflation peaked in June of 2022. The market expects the Federal Reserve to hold rates steady through March of next year, and then start lowering rates through the rest of 2024. However, if economic data continues to be strong and inflation starts to increase again, we think it is likely that the Fed will continue to raise rates. That would not be good news for either stocks or bonds, at least in the short term. Due to the rising interest rates, bond yields are way above their averages for the last decade. Investment-grade corporate bonds are offering yields above 5% in many cases. High-quality municipal bonds are paying about 3.5%, and high-yield corporate bonds are paying over 8.5%. Bond investors could be wise to take advantage of these higher yields. If the Fed does stop raising rates, then bond yields likely will fall, which will boost their prices. Historically, bonds have had very good performance after the Fed stops raising rates. In summary, the stock market and economy have been propped up by higher consumer spending, high corporate profits, and low unemployment. The direction of the markets will largely be determined by the direction of interest rates. Will inflation continue to drop, enabling the Fed to stop raising rates? Or will inflation remain stubbornly high above the Fed targets, causing them to keep raising rates? We are optimistic that we are close to the end of the rate hikes and the market rally has more legs to it. But as always, we will continue to monitor the markets and our investment strategies as conditions change. Thank you for your continued trust in us. And if you're not a client, we would appreciate the opportunity to sit down with you and discuss your unique situation. Thank you, and we'll see you next quarter.